Mining stocks seem to be back in favour with iron ore, base metals, and other industrial prices doing well. What's happening? And the big question is, can it last? John Mayer joins us now. He's partner and mining analyst at SP Angel. John, what's going on in the markets at the moment?
Well, these are very interesting times from an equity market financial perspective. Iron ore prices are at record levels. I'd like to say that's unexpected, but in many respects, we've been expecting iron ore prices to do well, given the amount of stimulus, the $15 trillion worth of stimulus that's been pledged to financial markets and to supporting various economies around the world. The US and China and the Eurozone are the three big economic blocks playing in this, and they keep adding to the stimulus numbers that are being pledged. Whilst a lot of that is going to support small businesses and offset the effects of the coronavirus, we also see a lot of this as going into new infrastructure projects. And so what we're seeing is steel producers in China, and let's face it, China produces most of the world's steel production, are ramping up their operations to meet expected demands for new housing, new bridges, new roads, new infrastructure. And there's going to have to be certainly changes to existing infrastructure, changes to allow people to social distance better. And I think changes in the longer term to shall we say, ease overcrowding. And let's face it, we're all keen on that.
To what degree is this also being fueled by a weaker US dollar? Of course, all commodities around the world are priced in dollars. And as we see the dollar sinking, one can't help but thinking that this is adding to the upside.
Well, it's actually the other key point, I think, for financial markets now, because as the US dollar weakens, and I think quite a lot of people expect the dollar to weaken now, partly due to the money printing that's going on in the US and the stimulus pledges that have been put in place and also and are expected. So if the dollar weakens, commodity prices that are denominated in dollars are likely to go up in dollar terms, and that's just one of those sort of things that happens because so many people are buying commodities in China and in Europe and elsewhere in the world. As the dollar goes down, the value relative in other currencies goes up, and so the dollar price improves. So we're not just talking about gold; we're talking about copper, iron ore, and other commodities, and those commodities are also being driven by restocking by manufacturers and factories and stuff like that. So you have a double whammy of commodities being helped higher, whilst the US dollar, which has been incredibly strong for many years now, actually comes off a bit.
Okay, well, the dollar aside, I was talking yesterday in an interview on IGTV with Professor Barry Eichengreen. He's the professor of economics at the University of California, Berkeley, and he was saying because the outlook is so clouded by COVID, we just do not know what the longer-term picture is going to look like. I'm talking mid-term to longer term. Because that is clouded, do you think the markets are perhaps possibly maybe getting ahead of themselves, or are you seeing real evidence that this demand is there, it's good demand, and it's going to hold up?
Well, it is a really difficult question to answer right now. On the one hand, we know that conventional economic theory would suggest that demand for metals and commodities should fall because there's slower global growth, there's going to be recession in certain parts of the world, and that's normally quite bad from a metals perspective. But it's different this time because really the recession is in other markets. It's more related to travel, to tourism, to aerospace. There's a lot of other sectors that aren't particularly metals consumptive that are being hit here. And the reaction by governments to stimulate economies, and the generally accepted best way to get economic growth back up and running again is to build infrastructure. So what we're seeing is manufacturers responding to that. We're also seeing consumers buying increasing numbers of fridges, freezers, ovens, to other domestic appliances because with more people working from home, they realize they've got to have more capacity in the kitchen and in other bits and pieces that they use at home. So they're actually out there buying stuff. And we see this in statistics from Alibaba. I expect we would see these in statistics from Google and Amazon and people like that. So although we would not classically expect demand to fall, actually it's not working that way in this case. The specifics of the environment we're in seem to be more metals consumptive. Yes, we've had a big hit with cars in that people haven't been buying cars for a few months, but now that so many people want to go back to work, but they don't want to travel in crowded public transport anymore, so more people are expected to go out and buy cars. If we take London as an example, the Mayor of London has jacked up the cost of driving into London yet again in order to keep pollution levels down. So people are going to be driven towards buying electric vehicles. So we expect electric vehicle sales to rise again. And in fact, they didn't really fall anything very much during the virus outbreak anyway, because people who'd previously ordered their electric vehicles were still happy to take delivery of those cars. Even through the lockdown, and that's been quite good for their sales. Yes, that's they're more premium products at the moment, but we do see that the cost of these vehicles coming down, and we see the performance of these vehicles actually improving as the battery technology evolves.
What about any insight you can give us into the supply-demand balances for 2020? Is this still too early yet to get a good idea as to just how things are moving in terms of what's coming through in the pipeline for those producers and how it's the demand side is balancing that?
Well, it's really difficult to know how the supply-demand equation is going to balance out by the end of the year. But what we are seeing is that lead and zinc smelters, for example, in China, are scrambling to buy raw materials, as in lead and zinc concentrate feedstock, and we're seeing the treatment and refining charges, which is what they pay for that feedstock material, are falling, and that tells us they're struggling to get the material from the mines because mines have been closed in Peru and Brazil and other parts of the world. I know Brazil's not under a total lockdown, but some parts of it have had to lock down because of the impact of the virus. And it's a little bit like the situation in the States. The president can say what he likes, but the local mayors who look after the towns, they actually run the show. So we are seeing problems with mines supplying material. That's causing a supply interruption. And so, yes, whilst we expect demand to be down on the year overall, it may be that actually the supply-demand equation doesn't look so terrible. So we are expecting there to be some build-up of stock by the end of the year, but it seems that metals prices are being pulled higher just as manufacturers restock and get going again. And when the crisis really hit, particularly in China, anyone who had any spare metal was dumping it back into the market so they could raise cash, and cash became king and all important. Now they're buying all that metal back again. We're seeing metal stocks flood out of Shanghai and LME warehouses, and we don't quite know where that's going to stop. But what we do know is there's going to be a lot less inventory in those warehouses. Well, we think there'll be a lot less inventory in those warehouses by the end of the year than we see now.
What about the flow of funds? Finally, just talk to us a little bit about where the money is going in the market at the moment. What are you seeing in terms of client money coming through and where it's being invested?
Well, certainly investors have been keen to take advantage of lower prices in the market. And it's a question of, well, where are you going to move your money around? So big funds, I'm sure, have been pulling out of aerospace and leisure and tourism type industries, and retail has been hit high street retail has been hit very hard, and they're looking for yield. And I mean, let's face it, if you're looking for yield plays, you either go to utilities, which carry on as they do fairly normally, but the mining stocks, if you look at Rio Tinto, BHP, Anglo American, they are making huge cash out of selling enormous volumes of iron ore into China. Brazil has had problems, so Vale will struggle a little bit this year. And so the Chinese are having to buy a lot of their better quality iron ore out of Australia, and that's Rio Tinto and BHP. And Anglo American will be supplying out. They will. I'm sure they're still supplying out of Brazil and South Africa. So those dividends for those companies should be pretty well set. So if you're an investor that was disappointed by it when Shell cut its dividend because of very low oil prices, which shouldn't have been a great surprise to everyone, I think the miners are offering a good yield alternative. And I notice Glencore is also relatively well set in this market. It's not a big iron ore producer, but it is big in the supply and the trading of commodities. And I think this is a great environment for Glencore to do well in.
Okay. All right, John, thanks for updating us on where things are at the moment. That's John Mayer, mining analyst and partner at SP Angel.